move-up buyer market, as rates drift lower, will probably pick up steam. People will feel less locked into their existing mortgage if it's 3.5% going to 6 versus 3.5% going to 7. But with that, I think it'll be a busier market in 2026. I think you'll see houses probably selling a little bit faster. You could see some multiple offers, maybe more than we've seen this year. And with that, getting an offer contingent upon selling your existing home, I think will probably become a little bit more difficult. So we've all probably done contingent sales this year, maybe for the first time in a couple years, because they haven't really been popular since COVID, when the market got really hot and there was multiple offers and it was more of a seller's market. As we've shifted to more of a buyer's market, you're seeing some of those offers get accepted. That might balance itself out a little bit in 2026 if the market heats up and there's more buyers entering the market. So having our move up buyers prepared to be able to buy non-contingent, I think, is important. I think it's good messaging to get out to people over the next 60, 90 days that might be looking to do something like that in 2026, that you have a solution for them. So we'll do a little market update, and then I'm going to do a really deep dive on different options and how that works. If you're near a computer, it'll be good to follow along to watch it on the screen. If I need to make it bigger so you can see it on your screen, just let us know, and I can kind of expand my view a little bit. So before that, let's jump into what's happening in the market today. So a couple interesting phenomenons going on right now. Okay, one, and I'm going to ask a question, you guys can answer this. Do you think that the Black Friday, and I guess today, Cyber Monday, do you think the numbers were better this year than last year, or worse? Like, were there more dollars spent or less dollars spent? Okay, so I got some betters, I got a worse, okay, more. All right, so only a couple of answers. What's interesting is the numbers were actually better, which is a bit of a surprise to me. In fact, they were 9% better online and between 3 and 4% better in person on Thursday and Friday, or Friday and Saturday, I guess Friday and Saturday. So a little bit of surprise to me, because you hear that the American consumer is being stretched thin. Income hasn't gone up at the pace of expenses, inflation, cost of goods, things like that. That hasn't stopped people from spending money. And here's my theory, and Jen Fanning, you're 100% spot on. There's two things I think. One is they're using credit. Okay. Why do people buy things on Black Friday? What do you guys think that is? Why do they buy it on Friday? Okay, Heather, better deals. Okay. Perceived deals. Okay, Bob Schoeneman, ding ding, that's the winner. Okay. And there's certainly better deals too. But I think it's a reminder to all of us that if people think they're getting a good deal, they're more likely to make a purchase than if they think they're not getting a good deal. Okay. And so in the real estate market in the past 2 or 3 years, do buyers think they're getting a good deal or not? What do you guys think? Yes or no? Do people think they're getting a good deal?
I think they are.
Okay.
Yeah.
Okay. I think most think they're not getting a good deal because interest rates are high and payments are high and prices are high relative to where they were. Um, I would argue that, especially in the last 6 to 12 months, a lot of people are getting good deals, right? There's some softening in prices, stellar concessions are available, rate buy downs, all kinds of things like that. Um, but to me, it's the perception versus reality, right? And so the American consumer for generations thought that housing, buying a house, that's the American dream, right? Now that American dream of home ownership has has less importance than it used to. And so we've talked on this call that we need to remind people the value of home ownership and kind of recreate that American dream. I think that's on all of us in the real estate industry. For a lot of people, the American dream is buying a 65-inch TV for $250 on Black Friday, right? Or other things that are cheap. And so, it's our job as real estate professionals and mortgage professionals to educate the American public that the American dream of home ownership might be more important than the American dream of a big flat screen. Okay. And you need a house to put the flat screen in sometimes too, as well. But it's just interesting. It's the perception that I got a good deal. That's why I'm spending money. Okay. Um, it's kind of like the people that spend money and say, "Oh, but it was a tax write-off." Yeah, it was a tax write-off. You still had to spend the money. Like yes, if you could deduct it, maybe it was cheaper after taxes. You still spent the money. So just kind of an interesting phenomenon that you're seeing over the weekend is the American consumer is still spending money, but where are they spending it? It's our job to educate them that real estate is a good place for them to spend their money. Okay, so other big news over the weekend. The president has announced that he has made his decision on who the Fed chair is. Okay, but he has not announced who the Fed chair is. But we know it's one of three, and I'm sharing my screen. So this is a service that we subscribe to. This is just their morning update. So it's either going to be Fed Governor Waller or Warsh, or National Economic Council Director Kevin Hassett. It's one of those three. Okay. When will they actually announce who it is? I'm not sure. Most people are expecting that's going to be before Christmas. That will be a market mover because the market will anticipate what the Fed's going to do next year when Chairman Powell's term ends, based upon who is announced as the Fed chair probably this month. So um, that news actually might be more important than what the Fed does this December. It might be more important than jobs reports and inflation reports. Who the Fed chair is probably going to be the biggest newsmaker this month. And unfortunately, unlike many economic reports that are released where we know days or weeks in advance when a jobs report, when an inflation report is going to be released, we won't know when that's going to happen. We'll just have to watch Twitter and it'll be announced, right? Whenever the president is ready to announce it. Um, but that will be a really important announcement. And it's no secret that President Trump has not been a big fan of Fed Chair Powell, at least over the last 12 months, 18 months. And so one of the reasons why he's talked about announcing his nomination for the next Fed chair earlier than historically the president would do is because they want the news of who the new Fed chair will be to be more important than what the current Fed chair is actually doing, if that makes sense. So, what's the Fed going to do in December? They're probably going to cut. Okay, what Chairman Powell says at the next Fed meeting normally would move markets. I'm guessing that the next Fed chair will be announced before the Fed meeting or immediately thereafter. But I think Trump's going to try to um, lessen the importance of what Fed Chair Powell says at the Fed's meeting in 2 weeks by announcing who his next pick is. And I think he wants his news of who his pick is to be more important than what Fed Chair Powell says in 2 weeks at the next Fed meeting. That's just my opinion. But that's big news. So very important, something for all of us to watch. I'm sure we'll talk about that next week. I don't think it'll happen this week, but probably next week.
Huh?
Okay.
It's
So the
okay.
economic calendar this week is pretty busy, but it's busy with some information that was dated. PCE, the personal consumption expenditure, that's released this Friday. That's not the November PCE. That's not the October PCE. That's the September PCE. And why is September just being released? Government shutdown, data wasn't compiled, they couldn't release it. So while the PCE would normally be a really big market mover, I'm not sure how much that's going to move the markets this Friday because the news will be dated. Although it will be a market mover. That's really the biggest news this week. Normally we would get a monthly jobs report this Friday. That's been delayed a week or two, so we're not going to get the November jobs report until middle of this month, right around when the Fed meets. And so we're still another probably week or two for all of this economic data to really catch itself up. Um, and the market's trying to kind of determine which direction to go based upon a lack of information. Um, I want to share the chart here because I think it's important to put it, we're near the end of the year, we're in December. What's the market done for the last 12 months? And so if I pull up a 12-month chart here, you can see, that the market sold off. Mortgage bond pricing went down, rates went up. in December and January. And so we started the year with rates moving higher. January 15th was the worst rates were all year. And even though rates aren't as low as we hoped, even though we're not in the fives, some programs, yes, but conventional loans, we're not in the fives without a rate buy down yet. And some of us had hoped we would be there by the end of the year. I think the government shutdown kind of put a pause on that. We are certainly significantly better than we were when the year started, and we are trending in the right direction. You can see the bond market has been on an upward tear most of this year, especially since May. That's when the tariff fear, would tariffs cause inflation, really was more or less over. But bond market's been improving. That means bond prices are going up, yields or rates are going down, and rates have gone down almost a full point since January. So we're trending in a positive direction. The last 30, 60, 90 days, it's been a bit of a pause. We've been moving sideways here. But last week, post government shutdown, we had a couple really good days. And so rates, in our opinion, continue trending in the right direction. They're continuing to inch lower. Not every day, there's day-to-day ebbs and flows, but we feel positive about the future direction of rates. As long as inflation remains moderate and when these economic reports catch up, we should continue to see that happening. I think what we've said on this call a couple times is the odds of rates being below 6 in December more or less went away when the government shut down and we had 45, 60 days of a lack of data. That probably pushed to the first quarter or sometime of next year. But the trend is positive, and I think the positive momentum of rates getting better is something we need to continue sharing on social media and with our customers. The Fed is meeting this month, so they're meeting next Wednesday, the 10th. Right now, there's an 85% chance that they're going to cut. That's been what the Fed has been projecting all along. They would cut 3 times this fall. September, they cut 0.25%. October, they cut 0.25%. And most expect next Wednesday, they'll cut 0.25%. That's already baked in. That's already priced into the market. Post-Fed meeting, what happens with economic reports, the jobs, the PCE, the CPI numbers that will come out after the Fed meeting, the president's announcement of who the next Fed chair is, that'll really be the big market movers next week and the week after. The Fed meeting is already kind of baked in. So positive news overall. We have to watch the market really closely this month as we figure out who the next Fed chair is, what their policies will likely be. And then once these economic reports that were government shutdown delayed get released, we'll know more about what's going to happen with interest rates for the next 30, 60, 90 days. Okay, so let me shift gears here. All right, so again, if you would like a copy of this, message whoever you work with on our team, and we will get this in your hands. So I'm going to walk you through a couple different scenarios, okay? And if I need to slow down, just pop it in the chat and just say slow down or repeat yourself. So okay, so I have a person or family that has $10,000 a month of monthly gross pre-tax income, okay? And their existing mortgage is $1,500 a month, okay? They have $500 a month of other debt, so let's say credit cards, car loans, student loans. So their debt to income ratio is at 20%, okay? If that person wants to purchase a new home, there's typically 1 or 2 challenges. Do they have the cash to put the money down without selling? And do they have the income to qualify for a new house without selling their existing home? Okay. So if they have the cash to put down without selling, then all we have to worry about is, do they have enough income? Okay. The maximum income for most programs is going to be somewhere between 45 and 50%. Let's just say 50% because the math's really easy, okay? So if I have $10,000 a month of income and I have $2,000 of other payments, that means I have room to have a $3,000 a month mortgage on my new house and my debt to income ratio is 50%, okay? If I don't have the cash to put down, then I might need to borrow against the equity of my existing home. To get that cash. And so let's zero this out real quick here. And let's say that I'm going to do a home equity line or a bridge loan against my existing house. And let's say that costs $500 a month. If it's a $80,000 to $100,000 home equity line, that's about what it's going to cost monthly. Okay. So let's say my new home equity line is $500 a month. Okay, now I only have room for a $2,500 a month mortgage, not a $3,000 a month mortgage. Okay, to keep my debt to income ratio below 50%. Okay, and so I've got new home, current home, existing debts. Let's say it's a car, and I've got their new HELOC, which is their source of their down payment. I'm still below 50%. And so, in either of those two scenarios, this person doesn't really need a lot of outside the box thinking. This person qualifies just fine, even if they don't have the cash to put down. If they own another home and they have some equity in that home, there's not a lot of like creative financing or unique programs that we're going to need. A vanilla conventional mortgage is probably fine. I would say of all the people that our team does that buy before they sell, half of them look something like that. Okay. Now let's talk about what kind of home equity line or bridge loan can they use against their existing house. So let's say their existing house is worth $400,000 and let's say they owe 200. Okay. So they have a lot of equity in their house. Typically, you can borrow around 80% of your existing home's value on a home equity line or a bridge loan. Now, we have programs that go to 85. There's possibilities to go to 90. So you can borrow a little bit more against your existing house that I'm showing here. But let's just use 80% as kind of a number now. That's a pretty acceptable, pretty realistic, shouldn't be difficult to execute to borrow against equity in your existing house. Okay. So 80% of 400 is 320,000. So this max total loans of 320, that's the maximum mortgage amount between their existing first mortgage and a new home equity line and or bridge loan that they would take out. People use home equity and bridge loans interchangeably. There's one key difference between the two. A home equity line requires you to pay interest monthly. So if I borrow 100,000, I have to pay interest every month until that loan is paid off, that house is sold. With a bridge loan, a true bridge loan, which not many lenders do, we do in-house, we fund it ourselves, it's cross country's money. You don't pay interest monthly. The interest that you owe accrues and it gets added to your loan balance. So if you take out a loan of 100,000, month one, it's 100,500. Month two, it's 100,000, and so on and so forth. It still gets paid off when you sell the house. So key difference between the two: home equity, you have a payment; bridge loan, you typically don't. Cost wise, it's pretty comparable. Okay, so in this scenario, this person could borrow up to about $120,000 against their existing property. So if they're buying a house for $500,000 and they want to put 20% down or 100 grand, no problem. They have the equity to do that. Okay. All right. Now let's talk about what if they don't have the income to qualify. Okay. So let's use an example here. So we're going to zero this out. Okay. And so we're going to say in the same scenario, they have their current home, which is 1,500. They have some debts of 500. Okay. Let's say they want to buy a new house and the payment is $3,500 a month. Okay. Well, now they have a DTI problem because their debt to income ratio is 50%. 50 is typically the max. How can I qualify without selling the existing house? So we have a portfolio in-house program, cross-country signature is what we call it, where we can exclude the payment on their existing house if they meet a couple criteria. Typically, it's they have some cash in the bank, could be a retirement account, and they have some equity in their existing house. But if we do that, then this existing home, we can zero that out. That $1,500 goes to zero. And now my debt to income ratio is below 50. Okay, so problem solved. So if it's an income issue, like this left-hand column, I don't really have any issues. I have cash and I have the income. This program here will solve for income if I can't qualify carrying both. We closed one last month in Orlando where the person had a 68% debt to income ratio when you factored in their existing house, their bridge loan that we did, their other debt, and their new mortgage. But because we could exclude the existing mortgage, it took their debt to income ratio from a 68% to a 43%, and they qualified. Um, and so that's one solution. Okay, so let me back this up here. So again, current home, existing debts. Um, let's say that they have income and a cash problem. How do we solve for that? Okay. So let's say they take out a home equity line of 500 that costs them $500 a month. And let's say their new mortgage is going to be $3,500. Now I really have a DTI problem. I'm not just 55, I'm 60 because I have the new mortgage on my new house and I have a home equity on my existing house or bridge loan, use that interchangeably. That was my source of the down payment. So this program will not only allow us to exclude that payment, it'll also allow us to exclude the payment on the home equity line. So that $1,500 goes away. The new home equity line goes away. My debt to income ratio went from 55 to 40 and they qualify. Okay. Um, so if someone has both issues, know that there's a solution for that. Um, so a couple of notes down here. You have to have 20% equity in your existing house. You have to have some cash reserves. So let's say the payment on the new house is $3,500. I have to have somewhere between 42,000 and 63,000 in cash reserves, meaning I have to have assets on top of my down payment to be able to exclude this. Typically, we find that in someone's like 401k. Okay, the third program that I wanted to highlight, and some of you are probably aware of this. So, Knock and HomeLight, they work very similar to our portfolio program. Knock and HomeLight will provide a bridge loan against somebody's existing house. They will also guarantee that they'll purchase the home from you at a predetermined price, which means we can exclude the payment on the house you're selling. The only negative with Knock and HomeLight is there's a fee somewhere between 2.25% and 2.5% of the price of the house you're selling. So what we found is the interest rate on the new mortgage may be a little bit cheaper if we do a conventional loan and use Knock or HomeLight. The cost is probably a little bit cheaper if we do our portfolio program because there's not that fee. Okay, I've got a couple comments here. So MK, your debts are really low at 500. That answer depends. If someone's got a $10,000 monthly income, are they going to have $1,000 a month of like non-mortgage debt, credit cards, car loans, student loans? Possibly. Um, Jennifer, your question here. So Jennifer is just making sure, are we setting them up for failure? We wouldn't recommend anyone do this unless there's two things. One is they're confident in the ability to sell their house within a reasonable time frame, which is something that I think you guys can give them advice on. And then two is, do they have a cushion where if they have to carry both mortgages for a period of time? Now let's look at the calendar here, because I think when you think about the calendar and you think about when is someone likely to have a mortgage payment due, I think that makes the carrying cost a little bit easier. So if someone were to make an offer on a house today, okay, when are they going to close? They're probably going to close in 30 days. And so let's say that's the first part of January, okay? If they close in early January, when's their first payment due? It's due March 1st. So if somebody makes an offer on a house today, December 1st, your first mortgage payment is probably not due for 90 days. It's not due until March 1st. So do you think you can get your house photographed, listed, under contract, and sold within 90 days? I don't have that answer. I think that's probably property specific. But if someone's confident that within 90 days can they sell their house, then they're never going to be in a situation where they have a payment on their existing home and on the new home. Now, one of the reasons why with our program we need to see that they have some cash reserves is because we want to know that they do have the ability to carry both properties if they have to for a period of time. We close a pretty large number of transactions like this, but it's for people that can afford the potential for carrying both. So hopefully, Jennifer, that answered your question. All right, and then the last piece of this, and then we'll wrap it up because it's getting close to 10:30. Oftentimes, what we see people do is if they buy before they sell, they don't always need the cash. They might just put down 5% on the new house. And so I want to show you guys what that looks like. You guys have all heard the term recast or reamortization and how that works. So if someone takes out buys a house for 500,000 before they sell their existing house, okay, and they just put down the minimum 5%. Here's an idea of what their mortgage might look like, right? $3,800 or so a month. Oftentimes, what we see people do is after they purchase and sell their existing house, they take the equity from their sale and they apply it toward the principal of the new home. And so, what happens in that case? I'm just estimating that, let's say it takes them a month or two for that to happen. So they've paid down their loan a little bit, let's say from 475 to 473. If they take $100,000 in this example from the sale of one home and they pay their loan down, now that goes from 473 to 373. The interest rate is the same. It's not a refinance. There's a $250 fee to do a recast. Some banks don't offer it. Some charge more. It's a lender by lender scenario. For us, we want to see that you've made one payment and it costs $250, and we do them all the time. And I have 358 months because let's say you've had it for a month or two before you do this. But in that case, your principal and interest payment goes down by about $640. Your PMI goes away because you've paid the house down to 20% equity, and your payment goes from $3,800 to like $3,061. In this example, it's like $750 a month that you can have your payment recalculated. So when we're talking to people about any of these buy before you sell strategies, a future recast is typically part of that discussion because they might not have a budget for a $3,800 payment long term. Like $3,000 might be their sweet spot. We might not be able to get them there initially before they sell their house, but we can oftentimes get them to where their payments within budget after they sell the house and they do a recast and the loan gets paid down and recalculated. So this is a pretty common scenario: minimum down, big lump sum when they sell their existing house. We would actually recommend this in most cases over doing a home equity line, because you're not tapping into the equity in your existing property. There's cost to do the home equity line. But if you don't have any cash, if you don't have the 25,000 liquid to put down, then a home equity line or a bridge loan is a good option. Looks like I've got a question from Linda. So Linda, the question is, does the bridge loan allow the seller to have enough to cover the down payment, closing costs, and reserves? A bridge loan, no. A bridge loan, the amount of cash you borrow against your existing house all has to go to the new house, which is your down payment and closing cost. You can't take out $100,000 bridge loan and only use 80,000 to buy a new house and keep 20 in cash. You have to put the whole 100,000 if you're doing a $100,000 bridge loan into the new property, down payment and closing cost. A home equity line, because it's not specifically tied to the new home purchase, it's kind of a standalone line of credit. You can borrow whatever you want and use as much or little for the down payment on a new house. So if I did a home equity line against my current home, I could borrow 100, put $60,000 down on the new house and keep 40,000 in cash. And we had one recently where we had someone do something similar to that. They took out 150 they put 50 down because they wanted to have 100,000 to renovate, and they want to renovate before they sell their existing property and move in. So home equity line gives you some flexibility there. So a lot of moving parts. Don't expect you guys to keep up with every specific detail of how these programs work, but we've gotten a lot of questions on details of how the program works. I think the high level message is getting the word out to people that it's possible to buy before you sell if you're comfortable with, I guess, the risk that comes with that of what if your house doesn't sell quickly. And then that, cross country, we have lots of options. So if you have people that you think might look to go down that path in the first quarter, let's, connect them with us, and we'll start having them discussions with them right now, and give them some advice so they have an idea of what it might look like going forward if it's something they might look to do at some point in 2026. All right. Again, if you would like a copy of that worksheet I just went through, message whoever you work with on our team. If you missed the first couple minutes of the call today, we are recording these now. If you would like a copy of the recording, same thing. We can have it to you here within a couple hours. And with that, guys, have a great day. Have a great week. And we will see you guys next Monday. Thanks, everybody.